drive through the heart of Kuala Lumpur and you cannot miss their names because they are almost everywhere, from Sunway, Genting, Berjaya, YTL, and even some of the iconic franchise brands that they own, like Starbucks, Kenny Rogers Roasters, like U-Mobile, the cellular network. These are actually conglomerates, massive holding companies that own large swath of diverse businesses, from property, utilities, retail, gaming. Now, a lot of investors actually avoid them because of this thing called a conglomerate discount. And if you don't understand what it is, don't worry. In this video, I promise to explain all this and why certain conglomerates work and certain conglomerates just don't work. Welcome back to another video. This is going to be chapter 7 of my book, The Malaysian Multibaggers, and my name is John Ho, Wealth Planning Director at Phillip Capital, as well as an investor that has been invested into stocks over the past 20 years. In this video, I'm going to show you why some companies or families actually build the business based out of ego and empires. A select few Malaysian families actually use the conglomerate model to build somewhat of an indestructible wealth machine. So we're going to explore chapter 7 and how you as an investor can learn to spot the differences in between the families that actually build indestructible wealth machines and those that actually destroy value. First up, let's look at Berjaya Group, a classic case of an overreach, an empire that grew too fast and stretched its tentacles into almost everything, but ultimately did not reward much in terms of shareholder return. So everyone or most Malaysians today would know of Tan Sri Vincent Tan, a household name. He was famous for starting off as a bank clerk, then selling insurance, and ultimately bringing the McDonald's franchise into Malaysia. But his real brilliant starting stroke of genius for business was really acquiring Sports Toto, the gaming company, while Malaysia was going through privatization, and injected it into an ailing listed company that he bought and turned it into what we know as Berjaya Group today. Now, the beauty about a gaming company, it gives a very predictable cash flow, and this cash flow actually fueled the acquisition for everything else. They bought into properties, hotels, the Starbucks franchise, selling Mazda cars. I know today it's a spin-off, Burmas, but in the days of the past when they used to own it, they were into telecommunications. They owned DG, and they spun it off as well, sold it off as well. But here comes the problem when you're trying to do everything. One is you have a very complex structure, and the incentive, because it's so complex in this web, how do you incentivize and making sure that every one of your subsidiaries are actually run very, very efficiently? And that's where I think Berjaya has not really done that. They had good brands, but ultimately, how do you bring it up to be as efficient and generate more cash to the group so that it can continue to invest and grow? The second thing was actually the complexity in tax, managing cellular networks versus that of selling coffees or building cars was completely different skill set. You had such a diverse, a wide array of businesses, and it's very, very different skill sets and niches that you need very, very skilled people, incentivize them correctly to run the business. And I think that they have not done well over the past 20 over years. And because of that, they only returned roughly about 123% over the shareholders over the long run. And empire building as large as Berjaya is today does not equal wealth building. I think you must know when to invest, you must know when to exit, you must know when to focus, and you must know where to double down on. Because by stretching your resources so thin, you become a jack of all trades, but you really are a master of none. So that is the story of Berjaya Group. Now, case study 2 contrasts Berjaya Group with YTL, which is very much focused into construction, property, utility building, and really started off in 1955, a humble construction company. They started building schools, roads, infra work, a little bit of infra work. And it was really during 1992 when the peninsula side of Malaysia actually experienced a national blackout. They actually lobbied the government and became Malaysia's first independent power producer. Prior to this, the generation distribution of electricity was solely controlled by state-owned Tenaga Nasional Berhad. Back then, it was not privatized or corporatized like what it is today as much. And I think that was one of their ways to wiggle the way to build to become what we call a generation, be into the generation business, where they became an IPP. And when they did this, you actually pioneered, or you built some sort of a predictable cash flow over the period of that concession. In this case was 21 years, and you have recession-proof cash flow coming into your company coffers. So once they realized that the PPA, or the power purchase agreement, is coming to an end, they did not stop looking even before that, and now they've pivoted into other utilities like Seraya Power in Singapore. They've pivoted into Wessex Water in the UK, and now into data centers, building data centers and owning it, because they know that that is very similar to the utilities game. There's a very high upfront capex costs. Yes, you are mandated to have that strength of the balance sheet to be able to finance these projects, but once you're done and the project is completed, there is a certain payback period after 6-7 years, or maybe even slightly longer. I'm not updated the latest economics, but yeah, after a certain period, that's where everything that you make from your sales almost goes straight to the bottom line after negating off your operating costs. So today, I think YTL is a good example. Stick to your circle of competence, which is engineering, and they built their conglomerate revenue and profit model really through borrowing regulated utilities to fund future businesses. Not everything worked out. There were, yes, telecommunications didn't really work out, but you see, because of that consistency of a utility business, they could afford to fail, for the lack of a better word. And while they are still trying to revive, yes, I still see their ads and marketing campaigns, but because of that fluke, for the lack of a better word, consistent cash flow, you are allowed to experiment rather than fighting it out in a consumer, business to consumer kind of brands, when COVID will impact you, boycotts, Jewish boycotts of Starbucks really impacted Berjaya Group as well. So it's not to say that the business model is flawed on the consumer side. It's just that the competition is really tough, and you are at the whims and fancy of consumer behavior changes. Whereas in a utility business, it's a locked-in revenue stream, locked-in profit stream. You just have to manage your cost, and that also is a high barrier to entry, because not everyone will have the balance sheet to build a utility or infrastructure projects. So there you go, case study number 2, YTL Corporation. And yeah, the shareholder returns, you'll find it in my book, so grab a copy of my book. Number 3, ecosystems and spin-off magic. So Tan Sri Jeffrey Chia, way back in 1974, as a trained accountant, he saw something that a lot of people didn't see, which was tin mining wasteland that on paper didn't look very valuable, but having the vision to build an entire ecosystem, right? He somehow managed to gather 100,000 back in 1974, which is a lot of money, right? Inflation adjusted, I'm pretty sure it's in the millions. And he built an integrated, he had the vision to build an integrated live, learn, work and play ecosystem. He built malls, he built universities, he built hospitals, he built a township, and they were just feeding off each other. I mean, like Bandar Sunway, if you go on any weekend, it's bound to be jammed, bound to be packed, right? And these are even people who are not even living in Bandar Sunway. There's people within the adjacent areas are actually coming into it. Not to say everything was smooth sailing for him, because there was a crisis that hit him, and hit him pretty bad, which was in the 1997 Asian financial crisis. They grew, and they grew on debt, and the debt was being called because of rising interest rates, rising debt rates, and they survived by slashing costs, and they pivoted heavily into what we call, or what we know as, recession-proof businesses. Things like healthcare, things like education. He doubled down on this too, by the way. And most recently, the recording of this video is in April 2026. They just recently spun off their medical arm, and it was a record blockbuster IPO in Malaysia. So there you go. You see, really recession-proof, growing by leaps and bounds. I think conglomerates can unlock massive value by spinning off their best parts and having it run on their own, because on its own, the healthcare industry is really riding the tailwind of growing middle class in Malaysia, growing income, aging population. Malaysia is going to be an aging population very soon, and the rise of disposable income within that area, within that ecosystem, actually fuels the growth of Sunway Medical. And if you look at who are the main few guys, you've got KPJ, you've got IHH Group, you've got Sunway. All of them are riding on this tailwind, and Tan Sri Jeffrey really played it to his benefit lah. It also spun off its construction arm in 2015, and it's working out well. You nurture them as a conglomerate, create value, run it very, very well, run it efficiently, and then you unlock the value again when you spin it off. There you go. Case study number 3, Sunway Group. Now, case study number 4, YTL Corporation, is really, I would say, an outlier, for the lack of a better word. They did not cozy up to the government or had good, they did not lobby as hard, because a lot of the businesses were outside of Malaysia. What really started off for YTL was actually a low-profile limestone quarry operator. And for those of you who are unfamiliar with limestone quarry, what do? Limestone is pretty much used in a lot of industries, and one of it is actually in construction. And from there, in 2003, Mr. Goh Nan Kyo, who is now the owner, majority owner and chairman, executive chairman of YTL, he actually bought it out. He ran it like a private equity firm, really just ruthlessly cutting off all the losers, just keeping the winners. And he used to run a very successful brewery business in Cambodia. And from there, he had the opportunity to actually build hydropower plant in Cambodia, in Laos, and selling electricity to Cambodia. And the Don Sahong hydropower project is the company's cash cow, or the float. If I'm borrowing Warren Buffett's playbook of using insurance as a float, the way I like to explain to people about YTL is their float comes from hydropower electricity. It took 12 years to actually build this project. And it had you have to have a lot of patience and capital, in a way. How do you fund that that project? It was $1 billion capex upfront, and today it virtually I wouldn't say it means money. They still have debt to pay, but the moment the debts are really pared down, there you go, massive cash pile, giving back to the holdings company that they can deploy into other things like their plastics manufacturing, plastics packaging manufacturing, their oleochemical, and other parts of the businesses that they will have the patience because they have the money. For those shareholders that believe in this growth, and ever since Mr. Goh took over, they would have been massively rewarded, about 13 times shareholder returns. Yeah, there you go. Case study number 4. Case study number 5, a conglomerate that is very familiar to the Malaysian consumer. Either you buy their raw materials in a supermarket or you visit a convenience store. Most parts of Malaysia, they don't seem to have a lot in East Malaysia. So this company is none other than QL Resources, and the origins of QL really traces back all the way from a fishing village, and the family that traded actually seashells, fish meal in the 1980s. So Dr. Chia Song Kun, he was the only tertiary educated child of the family. He started off his life as a math professor first before venturing back into his family business and growing it. I think their strategy for growing the conglomerate was really ruthless, what we call vertical integration. So all the way from the raw material production all the way until it reaches the consumer, that's where you get higher and higher margins, because most of the time if you create or produce the commodities and it goes through a wholesaler and it goes through someone that actually packages and brands it, your margins get lost along this transition. But if you can vertically integrate the whole thing, that's where you have scale. If you become one of the largest producers, you have scale, which is a very, very high barriers to entry for new guys coming in. Then as you go lower down, when I said lower down the value, lower down towards the consumer, right, downstream towards the consumer. That's where you capture more and more margins because of branding, because of distribution channels. And I think that's what QL has done very, very well. They produce their own animal feed, breed their own chickens, catch their own fish, even make the fish meals for other people. Actually, they're one of the largest fish bowl producers in Southeast Asia, if not, Asia. No, definitely it's within Southeast Asia. China will definitely be much bigger than that. Yeah, and I think they have a huge cost advantage compared to fragmented competitors that are not completely vertical integrated. I think that's the biggest. And when they bought the Family Mart franchise in 2016, they really, completely own the whole vertical chain. Eggs, surimi, chicken. My kids just love Family Mart ready to eat meals or ready to cook in a way. It's not entirely healthy, but it's convenience. And I think if you go to countries like Japan and Taiwan, it's an integral part of their daily lives. And I think with more urban density population, I think this will only grow, and this will only have a very, very long tailwind, especially for busy urbanites that want a quick, valuable meal, for the lack of a better word. I think you would have been very, very fantastically rewarded, because it's 110 times returns over the past 25 years. I don't think any conglomerate in Malaysia has come close to this. And if you were to look at it, if you see how the family philosophy actually runs the business, you would kind of understand why they are there, where they are today. So as a conclusion, what should you be looking at? What should you look for as a template to find that next great Malaysian or even global conglomerate? And I summarize it into three main things. The first one is really try to look for conglomerates that are into asset-heavy, very regulated industries like utilities, because they generate very consistent cash flow, and the barriers to entry is actually very, very high, because if you do not have a strong balance sheet, you will not be able to finance those kind of projects, right? Obviously, it takes a long gestation period, but it pays off very well, especially after you reach a point of profitability on a project. Wow, that's literally straight to the bottom line. The second thing you should look for is private equity style capital allocation. Now, what do I mean? Private equity, usually because they are not transacted or showcased on the open market, there's no volatility in the share price. And because of that, the way you invest is that you have more incentive for you to grow as much as possible, and you're a little bit more patient in terms of when are you going to reap your rewards. It's not going to be 6 months or 1 year. It's probably going to be 3-5 years, or sometimes in Don Sahong's case for Mega First, it was actually 12 years. So look for guys, owners of conglomerates or any business that is willing to bet strategically over longer periods of time. I mean, if you look at one of my favorite businesses around the world is actually Amazon, because if you look at their capex spend, it's just insane. I mean, back even in the days of when they were just running an e-commerce store, even before the days of AWS today, right? They just spend money and grow. They have to be profitable, yes, but they rather sacrifice margin today, knowing that when they build the scale for tomorrow, they can outcompete anyone else. Okay, that's number two. The third is actually synergistic integration and smart spin-off. So like QL, they did a full vertical integration. Sunway, nurture them when they're small, nurture them until they're sizable, and then you spin them off as independent companies that run on their own. I think that's where you have a second liquidity event. So you list as Sunway, yes, you already raise capital from the markets, you tap the capital markets, but then when you grow your baby into something that's also sizable, that's when you can have another liquidity event and raise capital from the market again. I think that's something that conglomerates, especially large conglomerates, need to do, because if you become entangled in a web like Berjaya and you don't grow them to a size and you can spin it off, I think that's where the value trap actually happens. When it's such a convoluted web of businesses, which one do you focus on? Which one is your real specialty, right? So don't get trapped in the conglomerate discount. You need a framework to separate empire builders from wealth builders. And I think you get to know more, a little bit more, not a little bit, a lot more nuances. I mean, this short video does not do justice to the chapter. So pick up a copy of my book, The Malaysian Multibaggers. It's in stores, in MPH, in Popular. You can even get it on Shopee, and you get a bonus toolkit in which I show you stock selection checklist, as well as of some of the multi-baggers globally that you can take a look at and consider to be part of your portfolio. So I look forward to seeing you in the next video, and happy investing.